Just introduce, we're welcome members. I'm Philip Ford, director of the association, and we're excited to have Dr. Robert Dietz on today to talk about good news only. Good news only. He's the chief economist for the National Home Builders Association. He's going to share with us a sort of update on the market and what's going on there and forecast. And like I said, I've told him he can only share good news. So we're glad to have you. Go ahead. I'll turn it over to you. So I know people want to get on, and we probably will take questions. So he's gonna do a slideshow. So if you have questions as you go through the presentation, just type them into the chat, and then we'll make sure he sees those and he can answer those questions toward the end. So, Dr. Dietz, welcome.
Great.
And thank you for coming on.
Yeah, thank you. This is one of my favorite BIAs in the country. I think I've visited you guys a number of times. So
Yes,
met
we always have.
I've met a number of you in person. That's sort of nice to be able to put faces to names. This is our national economic outlook, and I'll make sure that the staff have a copy of the deck, and I think they're recording this as well. We're going to walk through our current take and what I've been recommending in terms of consuming the data and the information is to think in terms of 2 months, 2 quarters, and 2 years. We're coming to the end of what we thought was a 2-month period where much of the economy would be on partial or full lockdown, where the economic data were going to be, frankly, historically bad. And we're now entering into what we think is the beginning of a 2-quarter period of stabilization and the seeds of a rebound. We think it's going to take 2 years, on the other hand, to get back to trend growth. So that's kind of how we're divvying up the economic data. We do think housing is going to be a leading sector in the economy. We are 15% of GDP. And for some signs of that rebound, it says 7 weeks on the slide, but we've actually had 8 weeks of gains for mortgage purchase applications. So there's a lot of pent-up housing demand. I know a lot of markets are seeing improvement in terms of traffic, in terms of individuals looking to buy homes, and to a certain extent we're being helped by those low interest rates, despite the fact that unemployment is fairly high. We got a surprise with the April new home sales data. I was looking for about a 20% decline based on the labor market, some of the data that we had taken from surveys. Nope. The housing data really came in strong. And in fact, if you add up the number of new home sales that have taken place in the US for the first 4 months of 2020, we're actually 1% higher than we were in 2019. So the April pace is down from the January seasonally adjusted pace. January and February were really strong months. But thus far in 2020, the industry is holding up pretty well. Now, you said only good news, so I'll put my bad news here, just concentrated. We do have a risk to the forecast, and that's the so-called second wave. I think a lot of markets have already passed their peak in terms of the virus. There is the potential for it to grow in the fall. I'm putting that chance at 1 chance in 3 that we see some localized lockdowns going into the fall. So I mean, it's less likely than not. It's less than 50% chance, but it's still a high enough risk that you should keep it in mind in terms of doing future planning. What's interesting is we've now had more than a week of protests and riots in most of the major cities in the US. There wasn't a lot of social distancing being practiced in those events. So in a sense, we actually ran kind of a real-time science experiment to see how much of the virus really can spread with large gatherings. And frankly, that should show up in the data over the next 4 or 5 days. Thus far, the news media seems to be really focused on the idea of growing outbreaks in places like Texas and Arizona. If you look at the national data, the numbers are generally good and we're trending lower. So the forecast I'm going to show you, it's got a sharp mid-year decline. We think more of a V-shaped recovery for housing, a little slower for the economy as a whole, but housing should lead the rebound. Now, one of the challenges in terms of doing a forecast right now is we really need to actually study the virus itself. So what you're seeing here, the blue line is the historic data on confirmed cases going back to early March. The red line is a forecast model based on an exponential growth of the virus, unchecked, that I built in March, and it was the idea the virus was going to spread and spread and spread and never slow down. Well, that red line proved to be wrong. In fact, the green line is really a closer forecast model for viruses. And it's actually consistent with the scientific literature, which is viruses do not grow exponentially. They grow along something called an S curve or a logistic curve, which is pretty fast growth up front. And that begins to slow down over time as people begin to social distance. The virus itself weakens, some seasonal factors, all these things mean, yes, it continues to grow, but you get to a period where it gets to be more like controlled growth. And that's kind of where we are in terms of the national data. So on this slide, I've given you my estimate of the number of people who are currently contagious. That's what those gray bars represent. You can see that number has been declining in the United States since late April. So we've got good news in terms of the virus, and this should give confidence to governors and mayors that reopening the economy is the right way to proceed, because the economic damage being done by the shutdowns at some point was going to be much greater than the virus itself. The other thing is we have to have a conversation about density. What I did here was take some of the virus data in terms of state deaths per million population, and that's on the vertical axis. The horizontal axis is a measure of population density, and all the blue dots are the states. And what you can see is there's a pretty strong correlation between the fatality rates and density. The more dense you are, the more dangerous the virus was. Now, I did not include in the analysis the red dot, which is New York. If you include New York, the relationship is even stronger. But the reason I put this up here is because there's a connection to housing and what we're going to go through. For the last 2 decades, it feels like I've spent my career debating think tankers and academics who want to argue about urban sprawl and use that as an argument to fight development. Single family, traditional suburban neighborhoods have proven to be fairly resilient during this particular public health crisis. And I think that requires a rethink by some of the opponents of home building to say, okay, what communities actually did persevere through this crisis in better shape? And I think single family structures are clearly a winner from that. And whether or not those policymakers and academics take that advice, I think we're going to see consumers do it. And so we are going to see demand move out from some of the central city areas in terms of tall multifamily buildings and seek out single family. And you need no better example of that than if you go into a large building in a downtown area. How do you get up to the top floors? You got to take an elevator. Taking an elevator is a key choke point, whether it's your building you live in or your building you work in. And that's going to have an impact on where people want to live. And that will be a kind of a positive indicator for housing. All right, so let's take a look then at our macro forecast. For the first quarter, the economy shrank at a negative 5% rate. For the second quarter, it's going to be a historic decline. Now, our forecast model's got about a negative 32, negative 33% growth rate. I think consensus right now is negative 40%, which means if you had that pattern of activity play out over 4 quarters, the entire economy would go down by 40%. It'll be the largest decline in growth rate terms that we've had since the end of World War II, when we stopped basically producing arms and started up a civilian economy after the war. Now, one area where I have moved more positive, a month and a half ago, I was thinking the third quarter would be flat, maybe even down a little bit. And the thinking behind that was that we knew the unemployment rate was going to be particularly high, and we were concerned about lending to small firms, and we thought maybe we'll see some additional declines in that third quarter. We've moved away from that now. And so we think the third quarter really is the beginning of the rebound, provided we don't see the virus outbreak, which means that this recession, which was government imposed as a public health strategy, will be really short and really sharp. In fact, by one estimate, the actual recession period may only last 3 months. So you can see it in the gray bar there. That's our recession bar compared to the Great Recession. Yes, the decline is a lot sharper, but it plays out over a much shorter period of time. And over the course of the second half of 2020 and going into 2021, we do see an accelerated growth pattern. But again, it's probably going to take about 2 years to get back to the trend that we were on before this. So there is a period of time required economic healing. With the labor market, we have good news, bad news. The good news in part came about in the last labor market report for May. Some economists have been expecting an unemployment rate 20%, 25%. Our top rate in the NHB model was about 19. Well, even that proved to be too high. The official rate came in at 13.3. If you calculate it correctly based on some notes that the Bureau of Labor Statistics gave us, The real rate's probably a little closer to 16%. But regardless, we expect by the end of the year, the unemployment rate to come down, probably come down to around 10% by December. And the good news there is that duration matters. So, economists have studied that how long you are unemployed has real impact on whether you want to buy a home or buy a car. So if you're unemployed longer than 6 months, it does have lingering impacts on whether you make those big ticket purchases. If you have a period of unemployment that lasts less than 6 months, yes, you tighten up your budget, but it doesn't have big impacts on those long-run goals. And so we think for most of these people, the 40 million people who have applied for unemployment benefits, for example, most will experience a period of unemployment that's temporary, that's more like furlough, and will certainly last less than 6 months. So that increases the probability of a fairly swift rebound. Now, something else that we looked at over the last couple of weeks at NHB in terms of my team was trying to analyze state exposure to vulnerable industries. Sorry, this is probably more bad news in terms of the initial order at the beginning of this presentation, but in terms of thinking about the sectors that have the highest unemployment, it is going to be states that have heavy exposure to tourism and hospitality. So the top state in terms of exposure is Nevada, and Florida is among that top tier. Now, it's going to be concentrated differently across metro areas, but that does give you a sense that this particular recession is highly concentrated in those areas like restaurants, tourism, travel, airlines, and so that is going to have an impact on those local labor markets. Now, we did the same data analysis, and we just looked at homeowners. It was kind of interesting. This reflects the fact that you've got Nevada and Utah as the most exposed, reflects the age dynamic of who's unemployed right now. If you look at the unemployment rate below age 25, it's 40% right now. And so Nevada obviously has a hospitality effect. Utah has the youngest homeowners in the country. It's a growing state, so you have younger households. So it too is now among the top tier in terms of states that are exposed to a particular level of joblessness. Consumer confidence is going to be key. We know consumer confidence took a hit as the stock market declined. Initially, it rebounded. That will bring confidence up in the future readings, which are backward looking, of course. But as I mentioned before, the real feature in terms of consumer confidence is related to unemployment. If we can keep people, their spells of unemployment less than 6 months, I don't think we'll see the kinds of consumer confidence declines that we saw during the Great Recession a decade ago. We're going to see a hit, but then it's going to begin to stabilize over that 2-quarter period identified as the stabilization factor. In terms of the financial markets, I think you got to give an A+ to the Federal Reserve. They've gone all in. And in fact, in yesterday's announcement of holding rates effectively at zero, Chairman Powell all but said we're going to keep rates where they are for the next 2 years. This was an incredibly supportive position they take. We take the NHB and senior officer team meet with the Federal Reserve once a year. So we had a Zoom meeting with them back in March. They are particularly focused on housing because they know that home building is the primary way that interest rates affect the economy. So the fact that they have basically corrected the mistakes of 2018, they're going to keep rates low. And then what does that mean then for interest rates? The 10-year Treasury is going to be about 1%. And we think the 30-year fixed rate mortgage, which is the red line on the slide, is right now a little bit below 3.5%. And it's going to stay there. It might trend a little bit higher over the next 2 years. Generally speaking, it's going to stay below 4%. That's really good for housing demand. That's why we see those gains in mortgage applications. The concern in terms of housing demand is less the rates, more the ability of people to bring a down payment to the table. So that's connected to the stock market for older buyers, and it's connected to savings for younger buyers. The other issue is the credit box has heightened. So, for example, mortgages outside of the Fannie and Freddie set of standards, that market a month ago was effectively shut down. It is improving right now, but generally speaking, low rates are good for housing demand. The other thing is that housing brought a lot of momentum coming into 2020. We were expecting the best year since the Great Recession. And you can see that in the blue bars on this slide. This is the growth in the number of homeowners nationwide. And that last blue bar, it was the best quarter for home ownership in the first quarter of 2020 since the Great Recession. The momentum had been building on the for sale side. It's been interrupted, it's been disrupted, but I think the underlying demand drivers that we've been talking about the last 4 or 5 years, that the industry was supply starved, really proven to be true. I mean, who could imagine? We still talk about a lack of inventory when we have double-digit unemployment and the sharpest recession since World War II. The inventory shortage is real, and the underlying demographics for housing remain positive. All right, let's take a look at the supply side. The labor shortage situation has got a little more complicated. The unemployment rate for construction workers right now has risen to about 15%. What we've been saying and recommending to local associations, the Home Builders Institute, and others is now is an opportunity to go and get people into the industry, given we have high unemployment among other sectors of the economy. But it's not just recruiting people in, we've got to train them. The red line here is a measure of worker productivity in the construction industry. It's been going down for the last 2 or 3 years, and that's a natural consequence of when older workers retire and they have a lot of skills. They're being replaced with younger workers with fewer skills, so productivity goes down. It's actually part of the solution, but it also sets up the agenda on the labor side that we need to work with those trade schools and community colleges to get people trained up, in addition to recruiting them for the long run and a career in construction. We're watching lumber prices on the supply side. Lumber prices went down as we entered this particular recession. The volatility recently doesn't compare to what we saw in 2018 with the imposition of the tariffs. But right now, lumber prices are about $450 per thousand board feet. We think they're going to continue to be volatile, but kind of average at that price. We see some increase in domestic production. And the good news on the lumber market is that even though the Canadian border is effectively closed for a lot of personal travel, the lumber market from Canada into the US continues, and that is helping on the supply side. Pricing is trending higher, though, as the housing market gains momentum in the beginnings of a rebound. The other thing on the supply side is global supply chains. In our surveys, we hear builders say that lighting fixtures, plumbing fixtures, things like that have become harder to find. It's not that there are shortages, but rather that sometimes the particular product you need at that particular moment is not available. So we think there's going to be diversification of the supply chains. And so just an example, I put up some data we looked at in terms of kitchen cabinets. And you can see the share here from Chinese suppliers going up. And I included in orange the Vietnamese share, because a lot of Chinese cabinets are sent to Vietnam. They get stamped made in Vietnam, and then off they go to be traded again. So that's really kind of Chinese production as well. But you can see in 2019 and 2020, that share going down. That trend is going to continue. So we're going to still be dependent on global supply chains for trade, but I think the sources are going to be more diverse. We're going to be less dependent on China. It's a function of the virus. And it's going to function of the fact that the global trade system has really been disrupted during this global economic crisis. And then lastly, on the supply side, we are watching lending conditions for builders to get loans for development and construction purposes. In the first quarter 2020 survey that we did of the industry, we found that those loans faced the tightest lending conditions they had seen since 2011. And this is data that we send to the White House every quarter. They know that housing needs to be a leading element of the recovery, and they are particularly focused on making sure that builders have access to credit. Mark Calabria, who at the Federal Housing Finance Agency had a year ago talked about looking at options like a secondary market for A, D, and C loans. I think that kind of discussion continues, because making sure that credit's available, particularly for private builders, is a key part of increasing housing supply. All right, let's take a look then at the forecast. We'll start off with some numbers that we actually ran at the start of the year, illustrating the degree to which we're underbuilt going into this recession. And again, that makes us totally different than the Great Recession. We were overbuilt more than a decade ago. We're underbuilt now, and these numbers are an example of that. If you look here, we've got single-family starts per year per million population in the United States. In the 1980s, the 1990s, and the 2000s, we were building about 41,000 single-family homes per year per million population. Yes, there were ups and downs within those decades, but pretty constant measure of production. Then the last decade, we all know, underbuilding for a number of years. and it left us nationwide with a housing deficit of about 1 million units. So the fact that we're underbuilt means that we're not going to see a big decline in home prices. It means that there is demand for additional construction, even during a period of double-digit unemployment. So when we ask builders about their confidence in the market, our primary measure is the NHB Wells Fargo Housing Market Index. It's our monthly builder confidence measure. It fell from a level of 72 2 months ago to a level of 30. It bounced up last month to a level of 37, and we get a new reading next week. My expectation is it's going to get above 50, which would indicate builders reporting positive market conditions as well. I use this to build our forecast model, and here is the national level projections. We're expecting about a 15% decline on net for 2020, but we're at the sort of the low point now, and we think we're going to rebound from this point forward. The forecast model really wants us to go back to the trend line that we've been on since the end of the Great Recession, which was this kind of sluggish growing trend, taking us back to ultimately what we think is about 1.1 million single family homes built per year. We still don't get there by 2022, so we'll still be kind of growing along this trend line. But 2020 will be a down year, maybe not as down as much as we expected 2 months ago when we were looking at more like a 20% decline. And then there's going to be a lot of regional differences. Before we started this call, I was saying that, if you look at the data for places like Texas, Florida, the Carolinas, pretty strong patterns where either flat or even some markets that are up on a year-to-date basis. And then you've got markets that are down, places like Alaska that are really sensitive to oil prices, which represents a kind of a separate economic crisis going on right now. The other thing is we're taking a look at areas where we think there's going to be some growth. And this would include areas in the lead BIA, for example. The areas in brown, orange, yellow, and red on this map represent small metro core areas, small metro suburbs, and then in yellow, you've got small towns, and in red, you have essentially rural areas. They represent about 47% of single family construction. And frankly, the areas in white, most of the media attention when it comes to housing. They are the large metros that have more than 1 million population. Well, we've identified these areas that are not in white as the growth areas going forward. Now, why is that? Well, because I think you're going to see more home buyers move out of some of these higher density markets. And the combination of telecommuting and not wanting to be reliant on office space that requires elevators, having to take a subway, basically all the things that make living in New York tougher, those things are going to drive housing demand and households outside of these markets and into these markets that are listed in brown, orange, yellow, and red. We think that trend has begun in the first quarter, and it's going to accelerate as we go through 2020 and into 2021. The other trend that we think is going to reverse is that home size has been falling for the last 4 years. That was a function of adding more entry-level inventory. Well, that trend is going to stop, and so home size is going to plateau, and that's going to turn up again. And the reason for that is home buyers are looking for more space, more home office space, more home exercise space. And so that's going to have an impact then on home design trends and the kinds of homes that builders build over the next 2 years. Now, I've been cheerleading the townhouse market for it feels like 3 or 4 years. I'm still kind of on that train. 2019 was a tough year for townhouse construction because of housing affordability headwinds. But I think the longer run upward trend for the market share, which is in red for townhouse construction, it will continue. We think that it's not just low density markets that are going to benefit from people moving out of the cities, but medium density environments as well. And that would include single family attached townhouse construction. And then a market that I've been a little more negative on over the last couple of years, which is single family built for rent. It's only about 4% of single family starts, but there's a window of opportunity here if you're already in this industry to claim some benefits. Now, I'm not recommending builders get into it that haven't been spent years sort of practicing this market, but I do think the market for this kind of home is going to go up a couple of percentage points because you're going to find there are plenty of people who are looking for a single family structure but can't afford a single family home due to the down payment requirements. And then if we turn to our apartment forecast, the decline for apartments is a lot steeper. This is a commercial real estate crisis. So multifamily is sort of straddling between single family and commercial real estate. Multifamily is going to do better than commercial real estate, particularly the retail space, the lodging space. But overall, for 2020, we think multifamily construction starts are going to be down more than 20%. And then they are going more slowly than single family, which is a reversal, by the way, of what we saw during the Great Recession when multifamily came back first. But multifamily is going to more slowly return back to its prior trend. So 2021 should be a growth year for apartment construction, but not 2020. And then we're going to see a bit of a shift in the kinds of apartments being built. If you look at the blue bars on the slide, that is the number of apartments being built in basically 50 plus unit properties, taller buildings. That trend has been in place since again the Great Recession, and I think it ends in 2020, and we're going to see an expansion for the properties in red, the 10 to 49 unit properties. So multifamily is going to both spread out geographically and occur in more garden style, low rise type apartments. We're still going to have, the usual high-rise development, but the shares are going to shift and it's going to move in the opposite trend direction that's been in place the last few years. And then remodeling, a month ago, we had remodeling down in 2020 by single digits. Now we've got remodeling flat. Talking to remodelers almost uniformly, they talk about being busy. Exterior remodeling has done well. We know there's going to be growth for things like addition, space changes, design changes in homes. And then the interior side of remodeling, which was challenged by the fact that people were a little reluctant to have workers in their homes, that's going to ease up, and the remodeling market, frankly, will fare the best of the three elements of residential construction. And I mentioned it before, but I just thought I'd put up some preference data. We had seen a long-run trend over the last 2 decades of more people wanting exercise room, home office space. I think those trends are going to go in 2020, and we put out our consumer preference study, goes out in the mail here in the next few weeks for the 2020 study. And then just sort of lastly, I talked about the virus a lot, but it is an election year. This is comes from our geography index. The counties in red are counties that voted Republican in 2016 for president. Counties in blue voted for Democrat. You see here that about 61% of single-family construction occurs in the red counties. And moreover, as a reminder that regulatory burdens matter, the growth rate in the red counties was positive at 2%. The growth rate for single-family construction for the blue counties was negative. So this is a reminder of the importance of local advocacy. It's why membership does matter so much, and it's a reminder that it's an election year, and election years matter in terms of determining the cost of home building and housing affordability generally. So just wrapping up, and I'm happy to take any questions if there are any. We're at the end of that first 2-month period. We're moving into the 2-quarter period where we really saw a pause of the economy. It is beginning to reopen. The virus spread is slowing. Yes, it is picking up in certain states, but nationwide, it's slowing. The hospital system seems to have the capacity to be able to handle this. That's an argument to open up the economy. People were trapped at home, working at home a lot. We keep waiting for the millennials to have the baby boom that seems to be out there. Hasn't happened yet. When I've done these calls, people said it's not a baby boom. We should expect a surge in divorces. I don't know. That's sociology more than economics, but either one of those would have some impacts on housing demand. But keep in mind the 2-month, 2-quarter, 2-year targets. I think that's a good way of digesting the information and thinking about how we get back to trend. But mid-year, second quarter, really weak. The rebound is in place. That's the reason the stock market has done pretty well. It's stock market's retreating a little bit today, doing some profit taking, but generally speaking, people are looking down the line and seeing an improving economy, and one that's going to be led by housing and home building. So I want to thank Lee BIA and the staff very much for the opportunity to kind of present our national outlook. eyeonhousing.org is our economics blog. Feel free to subscribe to it by email, and I've got my email address and Twitter address on this slide. And I don't know if Emily, any questions?
Yeah, open it up. Anybody having questions? You can type it in the chat, or you can unmute. I guess we can.
We don't have a question, but Bev, hi Bev. She says great presentation.
Oh,
and thank you.
Questions or compliments, that's how I should say it. But yeah, no, thank you very much. And like I said, I will share the PDF so you can share it to the rest of the membership.
Any questions? I've noticed, and I don't know, you know, our industry, our memberships have never been quiet people, but I've noticed on Zoom, everybody's quieter on Zoom. I don't know if that trends throughout the country in different associations, but I've noticed everybody's quieter and less willing to ask questions.
It has. I think it's you know, we train them so much to hit mute and stay on mute while the presentation goes on that they sort of less. It's, I have to admit that the one thing of not doing this in person is that I learn less, because one of the important functions of sort of getting out and meeting people is listening to them. And so it's one thing to sort of, you know, kind of say, okay, here's the information, but
Yeah.
hopefully by the time we get to next year, we'll be back out on the road doing these kinds of things. Well, if there are no questions, you know, I was very happy to be able to join you today. And I joined you from the NAHB office, so things are starting to maybe get a little bit normal back in DC. And thank you very much.
Thank you, Dr. Dietz. Thank you very much.
Thank you.
Everybody
Great.
take care.
Thank you very much.